Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. Today was Fed Rate Day. I thought it would be useful to look at how the Fed communicates and how that style has changed with successive Fed chairs. Now, today we're talking about something that matters to every real estate investor, whether you realize it or not. It's how the Fed communicates. Most people focus on whether the Fed raises rates, cut rates, or leaves them unchanged. But the words surrounding those rate decisions can move the bond market just as much as the decision itself. For decades, investors have tried to infer future path of interest rates just from every phrase, from every adjective, and every subtle change in tone from the chair. Alan Greenspan was famous for what many called Fed speak. His communication style was deliberately opaque. He believed ambiguity preserved flexibility. If the Fed became too specific, markets might treat the forecast as a promise. That could limit the Fed's freedom to respond when the economy changed. The problem is that the market still wanted guidance, so traders analyzed every sentence, every minor change in wording that could move Treasury yields. Greenspan said less, but the market often worked harder to interpret what he meant. Then came Ben Bernanke. Bernanke brought a more academic and transparent approach. His tenure included the global financial crisis when the Fed cut short-term rates to virtually zero. At that point, the Fed needed another tool. Forward guidance became part of monetary policy. The Fed could influence long-term interest rates by telling markets that short-term rates would remain low for an extended period. The idea was simple. If investors believed rates would stay low, borrowing costs could decline across the economy. That was especially important when the Fed could no longer stimulate the economy through conventional rate cuts. Bernanke also introduced regular post-meeting press conferences. The Fed became more transparent, more systematic, and more willing to explain its thinking. But forward guidance introduced a new risk. Markets could start treating conditional guidance as a commitment. We saw that in 2013 during the taper tantrum. Bernanke merely discussed the possibility of reducing asset purchases, and Treasury yields moved sharply higher. The market had become dependent on that policy map. Now, Jerome Powell inherited that communication framework and expanded upon it. Powell's style was more direct and plain-spoken. He held press conferences after every Federal Open Market Committee meeting and repeatedly emphasized that policy would be data-dependent. Under Powell, investors received a constant flow of information. There were policy statements, press conferences, meeting minutes, economic projections, the dot plot, and speeches from numerous Fed officials. That sounds like greater clarity, but more communication doesn't always mean less confusion. The chairman could say one thing, the dot plot would suggest something different, and one of the regional Fed presidents might offer a completely different interpretation the next morning. The market became highly sensitive not just to actual policy, but to small changes in the expected path of policy. Now, during the pandemic, Powell's Fed used strong forward guidance to convince markets that rates would remain low until the economy recovered. That helped stabilize financial conditions. But when inflation accelerated, the Fed had to reverse course quickly, and once again, markets learned that guidance is not a guarantee. Now today, we have Kevin Warsh. Warsh appears to be moving in a different direction. His approach is to say less, provide less forward guidance, and to allow markets to respond more directly to incoming economic data. The rationale is understandable. Economic forecasts are often wrong. Inflation changes, employment changes, energy prices move, fiscal policy shifts, and global events alter the outlook. If the Fed provides a detailed interest rate path, it can create a false sense of certainty. Warsh seems to be drawing a distinction between transparency and prediction. The Fed could explain why it made today's decision, but that doesn't mean it should promise what it will do a month from now or 6 months from now. There's also a concern that excessive guidance encourages too much risk-taking. When investors believe the Fed has mapped out the future, they might borrow short, lend long, buy duration, or sell volatility with too much confidence. A less predictable Fed may force investors to price risk more carefully. That ultimately could be healthier over the long term. In the near term, it's likely to create more volatility in the bond market. If the Fed provides less guidance, economic reports become more important. Inflation data would matter more. Employment data matters more. Wage growth, retail sales, energy prices, and Treasury issuance all matter more. The 2-year Treasury will become especially sensitive because it reflects expectations for short-term interest rates. We might also see larger moves around Fed meetings. Under heavy forward guidance, much of the decision is priced in before the meeting starts, but under Warsh, a wider range of possible outcomes might remain on the table until the statement and the press conference. That creates larger price discovery events. The long end of the bond market could also demand a higher price premium. A 10-year or 30-year Treasury yield is not determined only by the expected path of short-term rates. Investors also demand compensation for uncertainty, for inflation risk, and duration risk. If the Fed becomes less predictable, that compensation could increase. This is where the issue becomes directly relevant to real estate. Mortgage rates and commercial borrowing rates are not just driven by the Fed funds rate. They're driven by Treasury yields, by swap rates, lender spreads, and risk premiums. So the Fed could eventually cut short-term rates while long-term rates remain elevated. That's the risk investors need to understand, and the most likely outcome under Warsh is not chaos, it's more episodic volatility. Markets could remain calm between major economic releases and then move sharply after an inflation report, maybe an employment report, or a Fed meeting. So for real estate investors, the message is simple. Don't underwrite your project based on what the Fed funds rate is today. You want to stress test the deal under a 10-year Treasury that might stay elevated. You want to test refinance at wider lending spreads and test the exit at a higher cap rate. The market is being asked to rediscover price discovery, and that might produce better discipline over time. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.